If I told you that price goes up when there are more buyers than sellers, I'd be lying to you. In modern markets, that sentence completely wrong, and believing it is exactly how smart money unloads their bags on retail. Today I'm going to show you how price really moves using supply, demand, order books, and Wyckoff logic in a way you'll never unsee again. Welcome back to the channel. In this video, you'll learn why more buyers than sellers is a pranked myth, where real supply and demand actually live in the order book, who really moves price, how liquidity gaps create crazy spikes and crashes, and how Wyckoff's volume versus price logic lets you read the battle between big players and retail. By the end, you won't look at a chart as random candles anymore. You'll see a war between aggressive and passive money. Let's fix the biggest miscon first. People say price went up today because there were more buyers than sellers. Sounds logical, right? But here's the problem. On any exchange, for every trade, there is one buyer and one seller. The quantity bought equals the quantity sold, always. So there cannot literally be more buyers than sellers in executed trades. What actually changes is this: who is more aggressive? Who is more patient? Who hits the other side's orders? Price moves not because a magical extra buyer appeared, but because one side is attacking and the other side can't or won't absorb anymore. To really see supply and demand, you need to understand two types of orders. Limit orders, patient orders. I want to buy at this price or better, or I want to sell at this price or better. These orders just sit there waiting. They build the order book. Market orders, impatient orders. Fill me now. I don't care, just whatever is there. Here's the key idea. Limit orders are the real supply and demand. Limit buy equals resting demand, and limit sell equals resting supply. Market orders move price. They cross the spread, consume limit orders, and push price up or down. So, in Wyckoff language, supply and demand live in the limit orders. Price movement comes from market orders hitting that supply and demand. Let's walk through what actually happens when price moves. Price moves up when market buy orders hit and consume the sell limit orders at the ask. If buyers keep attacking, they eat through all sellers at that price. The next available sellers are higher, so price ticks up. And if you have short sellers with stop losses just above a level, when price tags those stops, they turn into market buy orders too. That's how you get short squeezes, forced buying on top of real buying. Price moves down when market sell orders hit and consume buy limit orders at the bid. Once those bids are gone, the next buyers are lower, so price drops. Long traders' stop losses turn into market sells, creating liquidation cascades. The summary is simple. Market buys lifting the offers equals up moves. Market sells hitting the bids equals down moves. Not more buyers, sellers. Just more aggressive buyers versus more aggressive sellers. Price doesn't only move because one side is strong. Sometimes it moves violently because the other side disappears. Imagine a supermarket. Today, water is $1 a bottle. Tomorrow, most suppliers vanish and shelves are almost empty. You don't need a huge rush of demand for price to go up. A few buyers are enough because there is no supply. Markets behave the same way. If sellers pull their limit sell orders, the ask side becomes thin. Even small market buys can push price way up. If buyers pull their bids, the bid side becomes thin. Modest selling can cause big drops. This is called a liquidity gap. Price jumps not because everyone is crazy bullish or bearish, but because there is no one on the other side. Wyckoff would call this no supply or no demand conditions, which are crucial in understanding where trends can extend or reverse. Now let's bring in Wyckoff's secret weapon, the relationship between volume and price. Think of it like this: volume equals effort, and price movement equals result. You don't need to know who is buying or selling. You just compare effort versus result. High volume, small price movement. Huge effort, tiny result. One side is attacking, but the other is absorbing. Example: massive buying at resistance, but price barely breaks and closes weak. Strong sellers are hidden there. Low volume, big move. Small effort, big result. The other side has vanished. That's your liquidity gap in action. Every candle, every bar, you ask, given this effort in volume, is the result in price strong, weak, or suspicious? That's Wyckoff's reading of the battle. All these micro mechanics, limit orders, market orders, liquidity, volume fit into Wyckoff's big picture. Accumulation, smart money quietly buying from weak hands in a range. You see big volume on down moves, but price doesn't make new lows. This is absorption of supply. Markup, demand dominates. Pullbacks are shallow. Breakouts actually follow through. Distribution, smart money selling to the public near the top. You see strong up bars on big volume, but then no follow through. Supply is overcoming demand. Markdown, supply. Your job as a trader is not to predict the future perfectly. Your job is to read who is accumulating, who is distributing, and whether the market is in a phase of absorbing or dumping. Next time you open a chart, use this checklist. Forget more buyers than sellers. Ask, is more aggressive right now? Think in orders. Limit orders are resting supply demand. Market orders are the actual movers. Watch liquidity. A thin order book means small orders create big moves. Read effort versus result, volume versus price action. Place yourself in the Wyckoff cycle. Are you with the smart money or providing exit liquidity for them? Forget more buyers than sellers. Ask, is more aggressive right now? Think in orders. Limit orders are resting supply demand. Market orders are the actual movers. Watch liquidity. A thin order book means small orders create big moves. Read effort versus result, volume versus price action. Place yourself in the Wyckoff cycle. Are you with the smart money or providing exit liquidity for them? Once you start thinking this way, you'll stop chasing every green candle and instead see where big players are absorbing, where retail is trapped, and where the real opportunity is. If you found this breakdown helpful, hit like and subscribe. Let me know in the comments if you want a full video on Wyckoff accumulation and distribution setups. Thanks for watching, and I'll see you in the next one.